In the midst of the AI gold rush, everyone's eyeing the prospectors, right? The AI model makers, the ones training the next big thing.
Yeah, the ones getting all the headline.
Exactly. But what about the companies selling the picks and shovels? You know, the ones building the actual physical backbone that makes all that AI possible.
That's a great point. Often overlooked, but absolutely crucial.
Well, today we're diving deep into a company that's betting its entire existence on exactly that, building the digital infrastructure for the AI revolution.
Is this a durable path to riches, though? Or is it more of a maybe speculative mirage?
That's the core question Wall Street is grappling with right now, isn't it?
It really is. It's a compelling question because Wall Street is incredibly divided on this company. It's a classic battleground stock where the future is, well, anything but certain. You've got this huge growth opportunity clashing with immense financial risk.
Welcome to the deep dive. Our mission here is to take a stack of your sources, articles, research, maybe your own notes, and really extract the most important nuggets of knowledge and insight.
And today, we're doing a custom deep dive into Applied Digital Corporation. That's trading on NASDAQ under the ticker symbol APLD.
Right. And just to anchor us, all the data we'll discuss is based on July 23, 2025.
Right.
That's when APLD's common stock closed at $10.93 per share.
So we're going to explore how this company, which was kind of forged from the ashes of crypto mining, now plans to build these AI factories of the future.
We've got a lot to cover, so we've structured this deep dive into two main parts.
Makes sense. What's the plan?
In the first part, we'll lay the foundation. We'll look at Applied Digital's business, evaluate its management, and really dissect its financials, the nitty-gritty.
Okay, the fundamentals first.
Then in the second part, we'll shift focus. We'll look at market sentiment, who actually owns the company, the inherent risks involved, and ultimately try to synthesize what it all means for you.
Got it. Foundation, then the broader picture and risks.
And just a quick reminder as we dig in, members of Stock Analytics AI get priority deep dives on tickers. We're actually covering all of the S&P 500 stocks over the next few months, so members get first dibs.
And if you just want a one-off deep dive on a specific stock,
Just drop us a super thanks. It's a great way to support the channel and get your request bumped up.
sounds good.
Okay, with that fascinating overview, let's start by laying the foundation. We'll dive into part one, their business, management, and the hard numbers.
All right, and kicking us off in part one is chapter one, business analysis, the picks and shovels of the AI gold rush.
Okay, let's unpack this. Applied Digital.
Yeah.
You might actually remember them as Applied Blockchain.
Right, they had a name change.
Yeah, and they've undergone this radical, almost overnight transformation. They've strategically pivoted away from the very volatile world of cryptocurrency.
Smart move, probably, given the swings there.
Definitely seems like it. And now they're laser focused on designing, building, and operating next-generation digital infrastructure, specifically for high-performance computing, or HPC, and artificial intelligence. That's a massive shift.
It truly is, and their operations reflect that now. They're structured into basically three main segments. You have their legacy data center hosting business.
That's the old crypto stuff.
Pretty much, mostly crypto mining customers. It accounted for about 83% of their revenue in fiscal year 2024, but, and this is key, that's not their strategic focus anymore.
Okay, so what is the focus?
The future is really in their HPC hosting business. This involves building and leasing these massive, power-dense data centers specifically designed for AI.
Wow.
And then there's a complementary cloud services business offering GPU as a service. So the model is clearly shifting from just, co-location for crypto miners
Right.
to securing these long-term, large-scale leases with major AI players. The goal is much more stable, predictable, and hopefully high-growth revenue.
So their key offerings, they sound really specialized. These aren't just any data centers, are they? What makes these AI factories, as they call them, so unique? And how does that GPU as a service fit in?
Yeah, you're absolutely right. These aren't your typical server farms. These AI factories are purpose-built facilities. They literally talk about transforming dirt into compute.
I like that.
It captures it well. They're designed for the extreme power consumption and, importantly, the intense heat generated by thousands of GPUs packed really densely together.
So cooling must be a huge challenge.
Exactly. We're talking innovative liquid cooling, redundant systems for maximum reliability. It's high-tech stuff. And on top of building these facilities, their Applied Digital Cloud offers that GPU as a service.
Which is like renting GPU power.
Basically, yeah. It's a turnkey solution. It gives clients on-demand access to powerful computing for AI, machine learning, rendering, whatever they need, without the huge capital expenditure of building their own AI factory.
Got it. So they build the factories, and they also rent out compute power from them.
Precisely. It covers both bases.
Okay, in terms of market position and scale,
Mhm.
they're emerging but scaling rapidly, you said. They're concentrated in North Dakota. Why there?
It's strategic. Cold climate helps with cooling, which saves a lot of energy, and they've secured access to relatively cost-effective power there.
Makes sense. So they have operational assets already.
Yes, they operate about 106 megawatts in Jamestown and 180 megawatts in Ellendale, but their future ambition is really massive,
Bigger than that.
much bigger. The Ellendale site is planned to become a 400 megawatt HPC campus. Just for context, that's enough power for a small city entirely dedicated to AI compute.
Wow, that's incredible scale.
It is, and a crucial landmark for them, the kind of deal that really makes the market take notice, is that 15-year, $7 billion agreement.
The one you mentioned earlier.
Yeah, to lease 250 megawatts of that Ellendale capacity to CoreWeave. They're a major AI cloud infrastructure provider.
Okay, so that's huge validation.
Absolutely. It shows they can attract top-tier clients for these massive long-term commitments.
So boiling it down, the primary value proposition is what exactly?
It's pretty clear. Providing ultra-low-cost, high-efficiency digital infrastructure for power-intensive computing, like AI and HPC.
And they achieve this through.
Strategic site selection, those cold climates for ambient cooling, access to affordable energy, and that purpose-built design focusing on high power density and liquid cooling.
Okay. And for the listener, why does this matter?
Well, this focus offers a really compelling economic advantage to hyperscalers and AI companies because power is often their single biggest operating expense. If APLD can deliver compute cheaper, that's a huge draw.
Looking at the industry now, Applied Digital is clearly riding one of the biggest tailwinds imaginable, the AI revolution.
No kidding. The high-performance computing market, which is really the engine behind AI, was already over $50 billion in 2023.
And growing fast.
Projected to exceed $100 billion by 2032. That's roughly a 7-9% compound annual growth rate. The catalyst is just this exponential expansion of AI and machine learning, requiring absolutely insatiable computational power.
Creates a perfect storm, really, for APLD's specialized infrastructure.
Exactly. They're positioning themselves right in the path of that storm.
But given this explosive demand, who are they actually up against? You say it's not typical competition.
Right. It's nuanced. Their most direct competitor is probably Core Scientific, CORZ. They also pivoted from crypto, interestingly, and they're competing for the same kind of large-scale contracts from a concentrated pool of hyperscale customers.
Like CoreWeave.
Precisely. The competition isn't about a crowded market of providers. It's a fierce race for scarce resources.
What kind of resources?
Massive power contracts, getting the rights to draw hundreds of megawatts is incredibly difficult. Suitable land, and of course, immense amounts of growth capital, billions of dollars.
So they aren't really competing with, say, DigitalOcean or traditional data center REITs.
Not directly. DigitalOcean DOCN is more cloud software focused. And traditional data center REITs usually deal with lower power density requirements, not these ultra-high power AI workloads. APLD is in a more specialized niche.
And speaking of land and resources, the regulatory environment must be a factor. You hear about pushback against data centers sometimes.
Definitely. It's getting more complex. Zoning, siting, permitting. Local communities can be resistant to these massive power-hungry facilities.
Plus environmental concerns.
Yeah, absolutely. Stricter mandates are coming in on energy efficiency, things like power usage effectiveness or PUE use of renewables, carbon emissions, even water usage for cooling. Data security and privacy regs like GDPR and CCPA are also a factor.
North Dakota's maybe easier for now.
Currently, it seems less restrictive, which is an advantage for them. But this is a very dynamic environment. Regulations can change.
And these hurdles, these barriers to entry, they sound monumental.
They really are. Probably the biggest is power availability. Just securing a grid connection for a multi-hundred megawatt campus can take years, literally years.
Wow.
Then there's the extreme capital intensity. We're talking billions for one campus. McKinsey estimates something like $5.2 trillion is needed globally by 2030 just for AI-specific data centers.
That's astronomical.
It is. Finding suitable land and site selection is also incredibly rare. You need that perfect convergence of power availability, fiber connectivity, and favorable zoning.
And you need the know-how.
And the supply chain, exactly. Specialized expertise, long lead times for critical components like transformers, switchgear, even the GPUs themselves. It's a tough business to just jump into.
So given all that, where does their competitive advantage, their moat, actually come from?
It seems to boil down to a few key things. Their brand strength is definitely building, largely through those strategic partnerships. NVIDIA, CoreWeave. That lends credibility.
Okay, what else?
They're aiming for cost advantages and economies of scale, using those strategic locations for cheaper power and cooling, trying to offer a lower total cost of ownership to clients.
And stickiness once a customer is in.
Exactly. Network effects and switching costs. While maybe not traditional network effects, those long-term leases create very sticky customers. Imagine the cost and disruption for CoreWeave to move billions of dollars worth of servers out of Ellendale. That 15-year lease really highlights this.
And this is where those unique assets and capabilities come in, right? The partnerships sound key.
They are absolutely transformative. That $7 billion, 15-year CoreWeave lease is a revenue anchor. It provides visibility that's almost unheard of for a company at this growth stage.
And the financing deal.
The $5 billion perpetual preferred equity facility with Macquarie Asset Management, that's crucial. It provides the growth capital they desperately need, but structured to minimize dilution for common shareholders. It's clever, though expensive, financing.
Preferred equity. So pays a dividend like debt, but it doesn't necessarily need to be paid back.
Kind of. It acts a bit like debt with its high dividend, but it's perpetual, giving them more flexibility than traditional debt. And finally, that relationship with NVIDIA. Being a preferred cloud partner and having NVIDIA as a direct shareholder, that's huge validation from the king of AI hardware.
So those are the big three pillars.
Plus, their first-mover advantage in niche geographies like North Dakota, locking up power and land where others maybe weren't looking as early. And their specialized technical design, those proprietary high-density liquid-cooled setups, give them an efficiency edge for AI workloads.
Okay, that makes their strategy much clearer. It's ambitious, but you can see the pieces.
Definitely ambitious.
And understanding this industry's growth and APLD's place in it is key. If you're finding this deep dive as fascinating as we are, folks, make sure to like and subscribe to the Stock Analytics AI YouTube channel for more content just like this.
Yeah, absolutely. And remember, members can add stock suggestions for future videos right there in the comments, and we will pick them up. It's a great perk.
Okay, let's move on. Chapter 2, Management Evaluation, Betting on the Jockey.
Right. And when you talk about Applied Digital's management, the story really centers on its chairman and CEO, Wes Cummins.
His background isn't typical for this industry, is it?
Not at all. He's not a traditional data center operator. He comes from the finance world, a seasoned technology investor and hedge fund manager. And that background kind of explains the company's unconventional path.
Yeah, I saw notes about the company's history.
Yeah.
Pivots from NASA contracts to potato processing, then crypto, now AI. That's quite a journey.
It is. He has a history of using the public company as a sort of shell to pivot into what he identifies as the next major market opportunity.
So is that agility a strength or a weakness? Does it make you question their long-term focus, or is it just smart adaptation to macro trends?
That's the million-dollar question, isn't it? But looking at his track record, particularly the recent pivots, you could argue it shows real agility and foresight.
Like the crypto pivot.
Exactly. When China banned crypto mining in 2021, that was a crisis for many. He pivoted from that to North American hosting, basically turning lemons into lemonade. And then after ChatGPT burst onto the scene, he pivoted again from crypto hosting to this much, much larger AI infrastructure market.
So investing in APLD is really, in large part, a bet on Wes Cummins himself, on his ability to spot these huge trends and capitalize on them.
I think that's a very fair assessment. It's a bet on the jockey as much as the horse.
And how are they on communication and ethics? Important factors.
From what we've seen, they maintain a high level of communication and transparency with the market, lots of press releases, detailed investor presentations, SEC filings. We didn't find any significant ethical red flags in our research.
Yeah. Now, capital allocation.
Right.
Where is the money going?
It's laser-focused on aggressive organic growth. Pretty much every available dollar is being funneled into building out these HPC data centers. That Ellendale campus alone has seen over $1 billion invested already.
So not much M&A. Acquisitions aren't the strategy.
Doesn't seem like it. Instead, it's all about these strategic financing partnerships, like that Macquarie deal we mentioned.
Right, the $5 billion preferred equity facility. Can you break that down again? How does it work?
Sure. Macquarie Asset Management, MAM, provides funding at the project level, specifically for the build-outs. APLD gets to retain 85% ownership of the projects, which is key.
Why is that key?
Because it minimizes the need to issue lots of new common stock, which would dilute existing shareholders. The proceeds are earmarked for completing Ellendale, paying down some existing debt, and funding their ambitious 2-gigawatt future project pipeline.
But this capital comes at a steep cost, right? You mentioned a high dividend.
It does, a very steep cost. It carries a 12.75% annual dividend, and that rate can even escalate under certain conditions. So yes, it's definitely a high-leverage, high-reward approach. They're betting they can generate returns well above that cost.
And what about returns directly to common shareholders? Buybacks?
Dividends?
None. APLD has no history of common stock buybacks or dividends. All capital is being plowed back into growth.
But they do use other high-yield instruments. Yes, they've issued things like a 9.0% cumulative annual dividend Series E preferred stock to attract financing previously. It just underscores their immense and frankly urgent need for funding to fuel this massive build-out.
Okay, so you're pouring billions into infrastructure. Return on invested capital, ROIC, must be a key metric to watch eventually. How does that look now?
Right now, their trailing 12-month ROIC is negative 5.68%.
Ouch.
Well, yes and no. For a company in this kind of massive investment phase, pouring billions into projects that aren't generating revenue yet, a negative ROIC is actually pretty normal. You wouldn't expect it to be positive yet.
So the investment thesis isn't based on current ROIC at all?
Not at all. It's entirely a forward-looking bet. It hinges on whether the future cash flows like that projected $467 million annually, just from the CoreWeave deal, once it's fully ramped, will significantly exceed the high cost of capital they're using to build everything out. It's all about future profitability.
We've explored their strategy, the management driving it. Now it's time to confront the numbers. The sometimes harsh reality behind this ambitious narrative. Let's turn to Chapter 3, Financial Analysis.
Right, and the numbers really do tell a story here. As of that July 23, 2025 date, Applied Digital's market cap was around $2.66 billion.
Okay.
But, and this is important, you have to look at the enterprise value, that was significantly higher, around $3.59 billion.
Why the big difference?
That nearly $1 billion gap. That essentially represents the company's net debt. So the enterprise value gives you a fuller picture of the total value of the company, including its debt.
Got it. What about revenue?
They're definitely in a hyper-growth stage, judging by plans. Their TTM revenue that's trailing 12 months was $221.19 million.
Which sounds okay, but...
But the key is that historical numbers are almost irrelevant here. The future potential is what matters. That CoreWeave contract alone is set to bring in an additional $467 million annually once it's fully operational. That would more than double their current TTM revenue.
So the potential jump is huge. What about profitability now, though?
Yeah, that's where the investment phase really shows. Their profit margins for the trailing 12 months are deeply negative. Gross margin was just 5.58%. Operating margin was negative 39.11%, and net profit margin was a staggering negative 110.40%.
Minus 110%. Wow.
Yeah. These figures reflect the huge upfront costs, the pre-revenue projects, high depreciation, high interest expense. Profitability, if it comes, depends entirely on successfully executing these HPC data center builds and achieving much higher operating margin on those long-term contracts.
Now, free cash flow. You mentioned this earlier. This sounds critical.
It absolutely is. Their TTM free cash flow is a massive negative $694.51 million, nearly negative $700 million burned in the last year.
That's a lot of money going out the door.
An almost unfathomable amount, and it's the stark reality of their strategy. Spend enormous sums now for potentially huge returns later, but it makes them completely, utterly dependent on external financing, like that Macquarie facility.
And net losses are consistent.
Yes, a consistent history of net losses. The TTM net loss was magnitude $244.19 million. So, make no mistake, this is a speculative investment based purely on potential future earnings, not current performance.
How does their balance sheet look? Financial stability.
Well, their debt-to-equity ratio is 2.00. That's generally considered a very high level of leverage. $2 of debt for every $1 of equity. It definitely amplifies the risk.
And short-term liquidity.
Their current ratio is 1.70. A ratio below 1.0 typically indicates strained short-term liquidity, meaning they might have trouble meeting near-term obligations without relying on those financing facilities. It underscores that dependence.
Okay, let's talk valuation. With negative earnings, the classic price-to-earnings PE ratio is useless.
Right, it's not meaningful. A more relevant metric, given the focus on future growth, is the price-to-sales PS ratio. On a TTM basis, it's approximately 12.0.
Is that high? Low? Average.
That's generally considered a very high multiple. It shows the market has baked in some really enthusiastic expectations for massive future revenue growth. The stock price is definitely pricing in a lot of optimism.
So how do we try to figure out what it should be worth? Intrinsic value.
That's where you might try a discounted cash flow or DCF analysis. The basic idea is simple. You estimate all the cash a business is expected to generate in the future, and then you discount those future cash flows back to their present value, accounting for time and risk.
But that must be incredibly difficult for a company like Applied Digital.
Exceptionally difficult. Forecasting revenue years out for a rapidly changing business, estimating future margins when they're currently negative, picking the right discount rate given the risks. It's fraught with assumptions.
So for educational purposes only, what did our model suggest?
Our educational model, which is highly sensitive to those assumptions, suggested an intrinsic value range of $9 to $16 per share.
That's a pretty wide range.
It is, and that wide range directly reflects the high degree of uncertainty and risk involved here.
What were the key assumptions driving that range?
Two main things. First, really dramatic revenue growth assumptions, especially that huge ramp up from the CoreWeave contract and other pipeline projects coming online, like a 100% plus surge initially, then moderating growth.
Okay, assuming the deals happen and scale up.
Exactly. Second, and this is a critical and uncertain assumption, we assumed their operating margins would dramatically improve over time, eventually reaching levels comparable to established, profitable data center operators. That's a huge leap from where they are now.
And the discount rate, you mentioned risk.
We used a high discount rate between 12% and 15%. That reflects the significant risks. The high leverage, the current unprofitability, the dependence on that single major CoreWeave contract for now, and just the general execution risk of building these complex facilities on time and on budget.
Okay, so just to quickly summarize those key financials again for everyone. Market cap, $2.66, and enterprise value, $3.59. TTM revenue, 221 bins. TTM net loss, net issue 244M. TTM free cash flow, a massive net issue of 695 bins. Debt to equity 2.0, current ratio 0.7, PS around 12, and ROIC, matic of 5.7%. Quite the picture.
It certainly paints a picture of high growth potential coupled with significant financial strain.
All right, let's move into part 2, the horizon and beyond. And our first segment here is Chapter 4, Market Sentiment, Wall Street's Divided Opinion.
Okay, and when you look at Wall Street analysts, the sentiment is overwhelmingly bullish.
Yeah, despite those financials.
Yes. Based on 10 analysts covering the stock, the consensus rating is a strong buy with an average score of 4.7 and a 0 out of 5. That's very positive.
And price targets.
The average one-year price target is $14.90. Compared to the $10.93 price we're using, that represents a potential upside of roughly 36%. The targets themselves range from about $12 up to nearly $19 per share.
So analysts are clearly focused on the future potential, the AI story.
Exactly. And the recent news flow and media tone have also been predominantly positive. They tend to focus on that powerful AI infrastructure narrative, the $7 billion CoreWeave lease, the Macquarie financing, the NVIDIA relationship.
The media often gives less weight to the financial risk we just detailed, though.
That's often true. They focus on the growth story. But here's where the division, that battleground idea, truly becomes stark. Short interest.
Ah, the bears. What's the situation there?
It's massive. In sharp contrast to the bullish analysts, there's a huge short interest of nearly 61 million shares. That represents an extremely high 31.46% of the publicly traded float.
31%. That's huge.
It's exceptionally high. It makes APLD a classic battleground stock. You have the bulls betting on the AI future and the bears betting against it, likely focusing on the debt, the cash burn, and the execution risk. This short interest is the clearest quantitative signal of the bearish case.
Okay, what about technical indicators? How's the stock chart looking?
From a technical perspective, the stock has actually been showing bullish momentum recently. That $10.93 is comfortably above both its 50-day moving average, which was around $9.43 to $9.64, and its 200-day moving average around $8.01 to $8.03.
So technically speaking, the trend looks positive.
Yes, those are generally considered bullish signals for both the short to medium and long-term trends, technically speaking.
So how do you reconcile these conflicting signals? Bullish analysts, bullish charts, but massive short interest.
It creates a situation with high potential for volatility. You've got these forces pushing in opposite directions. It sets the stage for potentially sharp moves, maybe a short squeeze if positive news or catalysts emerge, forcing shorts to cover.
Driving the price up
Yeah,
rapidly.
exactly. Or conversely, a sharp decline if negative catalysts hit, like project delays or financing issues, which would validate the short thesis. It's a tense setup.
Definitely a stock to watch closely. Let's move on to Chapter 5. Ownership structure. Who's on the inside?
Yeah.
Who actually owns APLD?
Okay. Ownership is dominated by institutional investors. Big funds, essentially. They hold about 73.5% of the outstanding shares, with around 431 institutional owners on record.
Any familiar names?
Yeah, prominent holders include names like Hood River Capital Management, BlackRock, the Vanguard Group, the usual suspects.
Okay.
But critically, NVIDIA Corp is also listed as a major institutional shareholder.
NVIDIA themselves. That's significant.
It's huge. It's not just a partnership. They actually own a piece of the company. That's a very powerful strategic endorsement. It signals real confidence from the absolute leader in AI hardware.
Wow. What about insiders, management, and directors?
They also have significant skin in the game. Insiders collectively own 9.28% of the outstanding shares.
And invest comments.
He's the largest insider shareholder by far. He owns over 23 million shares, which, at that $10.93 price, is worth over $250 million.
So he's heavily invested.
Extremely. And his trading history shows strong conviction. 36 purchases versus only 1 sale over the last 5 years.
That sends a strong signal. Any other insider activity?
It's worth noting, for balance, that recent insider activity overall has been mixed. While Cummins is buying or holding, some other directors have been selling shares.
Which could be for many reasons, of course.
Exactly. Sales can be for personal financial planning, diversification, taxes. Doesn't necessarily mean they lack confidence, but it's part of the picture.
So ownership seems quite concentrated among top institutions and the CEO. Is that good or bad?
It's a bit of a double-edged sword, potentially. On the one hand, it suggests alignment on the long-term strategy, especially with patient capital like BlackRock, Vanguard, and NVIDIA involved.
But the downside?
The risk is that if 1 or 2 of these large holders decided to sell a significant portion of their stake, it could have a major impact on the stock price due to the concentration.
But overall, having those sophisticated investors, especially NVIDIA, involved, that must provide some comfort against the purely financial bear case.
I think it provides a strong qualitative counterpoint, yes. These aren't naive investors. Their presence implies they see a credible path to long-term value creation, despite the current debt and cash burn numbers. It suggests the story isn't just hype.
Okay, that's helpful context. Now let's dive into Chapter 6, risk assessment. What could go wrong? We use a kind of SWOT analysis framework here. Strengths, weaknesses, opportunities, threats.
Sounds good. Let's start with strength, their internal competencies.
What stands out?
Well, first is that strategic vision and agility we discussed. Management, led by Cummins, has proven they can identify and pivot towards massive tech trends, from crypto to AI. That's a real skill.
Okay, agility is a strength.
Second, their expertise in financial structuring. Pulling off that complex $5 billion Macquarie preferred equity deal shows they know how to secure large-scale creative financing, which is crucial for this capital-intensive business.
Right, getting the money is key.
And third, their focus on specialized technical infrastructure. Building these high-density, liquid-cooled facilities specifically optimized for AI workloads is a core competency they're developing.
Okay, those are clear strengths. Now the flip side, weaknesses, the internal limitations. These seem significant based on the financials.
They are. First and foremost is the precarious financial position. That high debt-to-equity ratio of 2.0, the strained current ratio of 0.70, the balance sheet is stretched.
And the cash flow.
That's the second major weakness. Massive negative cash flow. Burning nearly $700 million annually makes them completely dependent on external capital markets remaining open and favorable to them.
Plus, they don't make money yet.
Exactly. A history of unprofitability. Consistent net losses mean the entire valuation is based on future unmaterialized earnings potential. It's inherently speculative.
Any other internal weaknesses?
Customer and project concentration. Right now, a substantial portion of their future revenue is tied heavily to the success of that single CoreWeave lease and the Ellendale campus build-out. If anything goes wrong there, it's a major problem.
Okay, weaknesses acknowledged. What about the opportunities? The future market potential?
The biggest opportunity is obvious, those massive secular tailwinds. They are perfectly positioned, theoretically, to benefit from the multi-decade growth predicted for AI and HPC infrastructure.
Riding a huge wave.
Absolutely. Second, they have a funded expansion pipeline. That Macquarie facility, assuming it functions as planned, provides a reasonably clear path to funding that next 2 gigawatts of future projects. That's potential for 500% scaling from their current operational base. It's enormous potential.
And the CoreWeave deal helps get more deals.
That's the third opportunity. That deal serves as powerful proof of concept. It could pave the way for further strategic partnerships with other hyperscalers or large AI companies who need similar infrastructure.
So huge opportunities they can execute. But now, the threats, the external challenges they face.
These are also significant. Top of the list is probably execution risk. Building these massive complex data centers is hard. Construction delays, supply chain disruptions, cost overruns, any of these could derail their plans and financials.
They're competing for scarce resources too, right?
Yes, that's the second threat. Intense competition for resources, fierce competition for those limited large-scale power contracts, suitable land, and, of course, capital. They aren't the only ones chasing this opportunity.
And the power itself, even if they get a contract.
That's a systemic threat. There are growing concerns about systemic power constraints globally. A shortage of available grid power could limit the entire industry's growth, regardless of APLD's specific capabilities or funding.
So, factors outside their control. What about broader economic factors?
Huge potential impact. Interest rates, for example, are a direct and significant threat. Higher rates increase their debt service costs on existing and future debt, making financing more expensive and potentially harder to secure. It could squeeze them badly.
And inflation.
Inflation is another threat. It increases construction costs, materials, hardware, labor, which compresses their project returns and makes hitting profitability targets harder.
Any geopolitical factors to consider?
Potentially. For instance, just hypothetically, imagine if the U.S. imposed significant tariffs in 2025 on technology hardware imported from Asia. That would directly increase their capital expenditures for building new data centers, straining their capital further, and likely causing delays. Geopolitics always adds uncertainty.
Okay, that gives us a very clear picture of the risks and rewards. Let's try to bring it all together in Chapter 7. Conclusion.
All right, so synthesizing all this, let's start with the bull case.
Okay, lay out the optimistic view.
The bullish narrative is pretty compelling. You've got a pure-play investment vehicle for the AI infrastructure boom. You have agile management that's successfully pivoted before. The business model feels significantly de-risked, at least partially, by that massive $7 billion 15-year CoreWeave contract, giving them unprecedented revenue visibility for a company like this.
Plus, they have money lined up.
They appear to have crucial access to growth capital through that $5 billion Macquarie financing facility. And importantly, they're backed by sophisticated institutional investors, including that strategic partnership and investment from NVIDIA.
So the bulls see the current financial weakness as just temporary.
Exactly. They view it as a necessary temporary phase, the cost of building the foundation for enormous future value creation in a rapidly expanding market.
Okay, that's the bull case.
Yeah.
Now, the bear case. It sounds just as stark.
It is. The counter-narrative focuses on the company being financially fragile, highly speculative, burning cash at an unsustainable rate, and carrying a mountain of debt.
Valuation based on hope.
Essentially, the multi-billion-dollar valuation rests entirely on future promises, not current performance or profits. The company is walking a financial tightrope, utterly dependent on external capital, and, crucially, on flawless execution of these incredibly complex, multi-billion-dollar projects.
And the short interest reflects this skepticism.
Perfectly. That extremely high short interest is the market screaming its doubts about their ability to pull it off. It's a clear signal of deep market skepticism.
And our valuation attempt reflected this uncertainty, too.
Right. Just to reiterate, our educational DCF model yielded that wide intrinsic value range of $9 and $16 per share. That range itself tells you how much uncertainty and risk is baked into any attempt to value this company right now.
So what's the concluding outlook? Where does the current price fit?
As of that July 23, 2025 date, APLD's share price of $10.93 fell within the lower end of our estimated intrinsic value range.
What does that suggest?
It suggests the market is pricing in the value of the confirmed CoreWeave contract, which is substantial, but remains justifiably skeptical about their ability to execute on the broader 2-gigawatt pipeline and achieve sustainable profitability across the board.
So the investment case really boils down to execution.
Entirely. It hinges completely on management's ability to execute its incredibly ambitious vision, navigate the risks, and convert those massive long-term revenue commitments into tangible, present-day free cash flow for shareholders. That's the bottom line.
So what does this all mean for you as you think about the future of AI infrastructure? Applied Digital is making a truly high-stakes bet, maybe the highest stakes bet on being the picks and shovels provider for this AI gold rush.
But given the monumental capital required, the intense competition for power and resources, and the company's current, let's be honest, precarious financial tightrope walk, will they actually be able to bridge that gap? The gap between huge future promises and much-needed present profitability.
Yeah, this deep dive really leaves us with a compelling, maybe slightly unnerving question. How long can a company realistically burn nearly $700 million a year before those future cash flows absolutely must materialize? It feels like the clock is ticking.
It certainly does. We hope this deep dive has given you a valuable shortcut to being well-informed on applied digital betting. It's a fascinating case study. If you found this valuable, please do like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out.
Absolutely. And remember, our members get priority deep dives on specific tickers. We're diligently covering all of the S&P 500 stocks in the coming months, and members get exclusive priority access to those.
And if you're looking for a one-off deep dive on a stock we haven't covered yet,
You can always drop us a super thanks. We look at those carefully when planning future content.
great. And just the necessary disclaimer. This analysis was generated by an AI system using financial data and sources up to July 23, 2025. It's for educational purposes only.
Yes, very important. This should absolutely not be considered financial advice. Please conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.